Water is good for you. You drink a lot of it, but too much of it,
it kills you. So that's a good point. That when it comes to personal finance, if some is good, more isn't always better.
Or as Jerry Seinfeld's joke was, when he goes to the doctor with a bad headache or something, it's like, doctor, work out the amount that will kill me and take it off a little bit.
And so, when it comes to diversification, the number of people who go, I'm invested in a global equities fund, let's say VGS as an example, it might invest in 3,500 companies, which might give the appearance of diversification, but actually it's 100% equities, 100% large companies, 100% Vanguard, and those companies will broadly behave very similarly. So you're not actually getting that much diversification, even though you've got thousands of names in the portfolio.
Well, so just on this diversification thing, and you could be like, yes, I'm diversified because I've got this ASX 200 ETF with all my money in it.
Yep.
Is 100% Australian shares good for you?
Probably not.
Because when you look at it, diversification, spreading all our risk in different pots is good. But if all the pots are Australian equities, if most of the pots are black holes and banks, if most of the pot or all the pot is in Australian dollars, you've got no diversification there. So I think it's a really good discussion. And so that's probably the number one red flag. These are probably in no particular order of priority, but it's transparency and diversification.
Yeah. So if you're trying to pick a super fund, you've got to hitch your wagon to one of them. At LifeShopper, we limit our list to the ones that manage $10 billion or more. That amounts to probably 90% of the dollars, but about maybe an eighth of the managers. So that's our first cull. Then you start looking at, what's the underlying products look like? What's the pricing look like? What's the service like? What's the track record like? And so having hitched your wagon to a trustee, you now have to make the biggest decision after you've done it. And your choice of which trustee will drive the structure of the fund and hence the amount of tax you're going to pay over your lifetime. So big decision.
Yeah.
Next decision is what's my asset allocation? Now, that's a fancy way for saying how do I diversify my money across different classes? And asset allocation will drive 90% or more of the underlying returns. That is, it matters more how much of your money is in equities, how much of it's in Australian equities, much more than whether you buy Telstra or BHP. And that's really a spread across real estate, infrastructure, bonds, gold, cash.
Okay. Can I jump in there?
Sure.
Because this is a really good point. I'm on the cover. Well,
I'm
not
on
the cover of this one, but I've booked in my photographer in a month's time because I need a few weeks to lose a few kilos. We might be putting a photo of me on the front of Retire Right. But because this could be things, what to ask your financial advisor around the investment selection. What's the asset allocation?
Yep.
Those should be, if they can't answer that, run.
And how does it align with my risk profile?
Yes.
That's number one.
2, ask them what is the underlying investments of each of the allocations segments. So what are the underlying investments with Australian equities? Yep. Then what you could do, you could ask them within that underlying investment, what are the actual companies?
Yes.
Because any financial advisor or fund worth their salt can 100% answer those three things.
That's right.